Hi, and welcome to our assignment 2 for trimester 3 for accounting for decision making. I am doing this assignment with Kane Nissenbaum. We are group 198, although we will not be in the same video together as we are on different sides of the world. This assignment is to compare two different companies, in this case airlines, and see which one is the better investment and which one is more profitable. Starting with Virgin Australia, the profit margin ratio, which measures the net profit amounts generated per dollar of sales revenue. Virgin is currently sitting at minus 2.45, which is not ideal for the company. They are currently losing 2.45 cents for every dollar of sales revenue, which isn't sustainable. They may need to change something like their cost control in order to fix this. Similarly, with the gross profit margin, which the gross profit is the surplus of revenue after goods sold. The profit margin for this is also not great, negative 1.2, which means they are losing 1.2 cents for every dollar of sales revenue. They may need to change, amend stuff like the buying or selling strategies in order to fix this. The return on assets ratio measures how efficient companies are in using their total assets to generate a profit. Virgin Australia is currently sitting at minus 2.65, which means they are not making a profit from currently using up their assets, which is not a sustainable way to run a business. They may need to lower expenses or something like that in order to try and make it more profitable. The return on equity ratio, which indicates how the percentage of return in investment to shareholders. A higher ratio here is better to attract more investors, more stakeholders. Although Virgin's number is not great at all, minus 10.3. So this potentially may have a bad view or be harmful for the company. To the liquidity, the current ratio measures the amount of assets in dollars compared to the amount of liabilities in dollars. The current ratio here for Virgin Australia is 0 to 78, which isn't ideal for the company, which means they currently have more liabilities that they need to pay off in the short run than compared to assets that they can work with in the long run. So they will need to pay these off before. For all the inventory turnovers and the debtor ratios, this is a service company, not a sales and product company, so they really wouldn't have much inventory, so this wouldn't be included. For the solvency and capital structure, the debt to assets ratio indicates how much dollars of debt per dollars of assets. When Virgin Australia's debts to assets ratio is worked out, it's found that the ratio is 82.3%, which is not ideal, as the rule is if it's above 50%, then the liabilities of the assets will need to be paid off and they are greater than the assets. In the interest cover ratio measures the comfort level of the entity in meeting its interest commitments from earnings. Australia's EBIT is currently at 0.2. Virgin Australia's EBIT is currently at 0.28, which is not ideal for the company either, which is not the best number, as they will not be able to meet their interest commitments from their earnings when compared to Air New Zealand.
Hi, my name is Kane Nissenbaum, and I'm the second member in this group assignment for accounting for decision making. After comparing both Virgin Australia and Air New Zealand, it was found that Air New Zealand is the more profitable organisation. This decision came about after a few key accounting stats were found to show that Air New Zealand was a more profitable organisation than Virgin Australia. These stats, or ratios as we could say, were the profit margin ratio, the gross profit margin ratio, the return on assets ratio, and finally the return on equity ratio. All these four stats, or ratios, as we could call them, were significantly contrasting in favour of Air New Zealand. For example, the profit margin ratio, Virgin Australia was sitting at negative 2.5%, in contrast to Air New Zealand, which was sitting at 7.11%. Additionally, the gross profit margin ratio, Air New Zealand was 23.6%, which is pretty strong, in contrast again to Virgin Australia, which is sitting at negative 1.2%. Additionally, again, the return on assets ratio, Virgin Australia was at negative 2.65%, whereas Air New Zealand was 6.22%. All of these stats indicate that Air New Zealand is a more profitable organisation and received more money per dollar spent